When you hear the word millionaire, it is easy to picture trust funds, high-stakes Wall Street gambling, or a genius eye for picking the perfect stock. But the most reliable route to $1 million actually bypasses all of that. It relies on a simple, straight path. Over the next few minutes, we are going to build a quiet, automated wealth-building machine, one that operates entirely in the background of your life. You do not need a finance degree to set this up. You need an internet connection, a valid ID, and a commitment of a few $100s a month. We will use a strategy called index fund investing. Professional, full-time investors consistently struggle to beat the market average. So instead of trying to outsmart them, we are going to join the market itself. By stepping away from the keyboard and letting a proven system run on autopilot, you remove human error. You can build serious wealth systematically, simply by letting the math work. To understand an index fund, imagine betting your entire savings on one single company. If they fail, your money disappears. An index fund fixes this by taking hundreds or even thousands of businesses and bundling them together into one single investment. You are buying a microscopic piece of the entire market. Historically, the overall market grows at an average rate of 7 to 10% per year. It is mathematically safer to capture that steady average than to gamble on picking the next big tech giant. The engine driving this strategy is compound interest. Your initial investment earns a return this year. Next year, you earn returns on your original money, plus the returns you already accumulated. The money stacks on top of itself. This chart shows exactly how that stacking plays out over 30 years. The bottom line represents a steady contribution of $300 to $500 a month. The top line tracks your actual wealth. Over time, it aggressively curves upward, crossing the $500,000 and eventually the $1 million mark. Compounding growth generates the vast majority of that final $1 million. The early years feel incredibly slow, almost invisible, but give it enough time and compounding takes over, turning small deposits into an unstoppable force. Step 1 is setting up the architecture. You need to open an investment account. Find an established brokerage or choose a retirement account built for long-term investing, and click Open Account. This account is completely empty at first. It is just a container. Once you link your bank and transfer your first deposit, the account has the capital required to purchase your first shares. Step 2 is picking your investment. You want a broad index fund. This is a specific type of fund that tracks a massive section of the global economy, rather than a specific sector like robotics or software. It is easy to get paralyzed by thousands of options or lured by hype stocks promising fast cash. Ignore them. Type in the ticker symbol for a broad market fund, verify the one simple result, and select it. By purchasing a broad fund, you insulate yourself from individual corporate failures. Your financial future is now tied directly to the long-term upward trajectory of the entire economy. Step 3 introduces the precise point where most investors fail. Up until now, everything required a one-time effort. From here on, the system requires unbroken consistency. You have to reframe how you view this money. This monthly deposit is a non-negotiable bill. Treat it exactly like your rent or your mortgage, except you are paying your future self. To guarantee you pay that bill, go into your account settings and locate the automatic recurring transfer menu. Enter your monthly amount, choose a date, and toggle it to on. Check your dashboard one last time to confirm the active schedule. Once that status reads as recurring, your job is officially outsourced to the software. Automation protects you from yourself. It prevents you from forgetting, removes the emotional hesitation of parting with your cash, and stops you from waiting for perfect market conditions. Consistency always beats timing. Step 4 is entirely psychological. Once the system is running, you have to log out, step away, and refuse to check your balance. The market drops, sometimes steeply. When you view your investments on a multi-decade timeline, a sudden drop is not a disaster. It means the assets you are buying automatically every month are temporarily on sale. This graph tracks the daily movements of the stock market. Up close, it is erratic and volatile. Checking this every day creates immense stress. But by zooming out over 30 years, those jagged, terrifying spikes fade into a smooth, steady upward slope. If you see a dip, panic, and sell your shares out of fear, you lock in that low price. You turn a temporary paper loss into a permanent reality. If you leave it alone, the market corrects, recovers, and continues climbing. Doing absolutely nothing while the market panics sounds incredibly boring, but mastering that boredom is exactly how you survive long enough to build actual wealth. The second you activate that recurring transfer, your machine is online. Without lifting a finger, you are systematically acquiring a small piece of the global economy every single month, year after year. There is no flash here, no instant gratification or sudden windfall. Real wealth is built slowly, quietly, over years by ordinary people who just keep going. Even if you feel like you are starting late, or you can only spare a small amount right now, the math still works. Starting today will always beat waiting on the sidelines. Pick a number to commit to. Set up the automation, then close the laptop, step back, and let time inevitably make you